You have counterparty risk. That means that you have a complete market breakdown, and it's a bigger story than just GameStop. It's the whole market is not able to function.
Yeah, got me in this party all up in the zone. Hottest Betty's trying to take away my cell phone. Like, come and party, I've been trying to shake you off my mind, but just can't.
The entire US securities exchange market almost collapsed yesterday. Yeah. And unlike other clickbait videos spewing bullshit here on YouTube, in this video, I will explain everything that happened exactly through the lens of complex intricacies and fundamentals of how the entire securities exchange market operates here in the United States. But before that, I realize this video is going to be long. So at least stay for the first 2 minutes and I will give a short TLDW summary and overview. TLDR, Melvin Capital fucked up so bad that they were about to destroy the entire market through counterparty risk, leading to a massive liquidity crisis. Since Melvin and the other hedge funds were too big to fail, to prevent a complete market collapse, DTC had to screw the clearing firms, who then had to screw the brokers, who then had to screw retail traders, by raising settlement collateral from 3% to 100% on GME, AMC, and KOSS. This led to a trickle-down effect, which shut down GME trading and a few others, and then drove prices low enough that Melvin Capital wouldn't collapse and take the entire securities exchange market with it. What does it mean? Basically, Melvin Capital over-leveraged and was about to destroy the entire market. DTC couldn't let that happen. Thus, DTC forced retail traders to bail out Melvin Capital shorts through a series of trickle-down events that started with DTC raising settlement collateral on GME and other stocks from 3% to 100%. What does this really mean? In short, Melvin Capital fucked up so big, so DTC forced you to bail them out. If you didn't understand any of that, don't worry. Most people don't. But if you keep watching, I will explain it to you. But first, let's hear from the CEO of Webull and get some supporting evidence from him.
DTC is the go-to company. They own this business, basically. They pretty much have a monopoly. There are alternative ways to settle trades, but DTC settles more than 95% of trades that happen on the street. Now, DTC needs to maintain an orderly marketplace, meaning if you sell a share, you are going to receive payment for those shares. That's what they guarantee. In order to guarantee that, they set collateral rates for custodians, right, or clearing firms. So typically, on a typical day, there is 2 days till settlement. You trade today, you have tomorrow, Friday, and then you have Monday. So the stock will settle on Monday. Those 2 days, meaning Friday and until the funds actually come and exchange hands, so to speak, someone has to fund that trade. And the clearing firm does that. That's one of their jobs. And typically, there's a collateral of about anywhere from 1% to 3%. So if you were selling a share of Apple, that clearing firm until settlement date would pay 2% of the notional value of that trade to DTC that DTC will hold as collateral until settlement happens.
If you didn't understand anything Anthony said either, don't worry. I'll explain now. So what Anthony explained, basically, he revealed the skeletal structure of how trading works behind the scenes in the US securities exchange market. There's 4 layers. First layer is the DTC, also known as DTCC, Depository Trust and Clearing Corporation. This is the mothership, right? So it's basically a monopoly that settles around 95% of all funds from trading in the US. Traditionally, funds take 2 days to settle. Everyone knows this, right? If you have a cash trading account, you know this especially because you know that once you buy and sell a stock, you cannot use that buying power again until they settle for 2 days, right? But the purpose of DTC is to provide liquidity in the meantime. If you have a margin trading account, you know what I'm talking about, right? In a margin account, you don't need to wait for funds to settle because you have DTC working for you, right? So they provide liquidity in the meantime if you have a margin account. So this makes sure that sellers get their money when they sell. However, there's a catch, right? And DTC is not going to do this for free. It needs to protect itself. So usually it requires around 1% to 3% collateral just in case. So where is this collateral coming from? It's coming from clearing firms, the second level. Some examples are Apex clearing, although some brokers do their own clearing themselves. So these are basically intermediaries between the DTC and the brokers to clear trades, right? So they are the ones who are paying the collateral to DTC until the trades settle. And then the next layer are the brokers. These are Robinhoods, Webulls, interactive brokers. So these platforms are merely there to facilitate exchange of securities between traders. Nothing more. They just facilitate the exchange, right? And then the next level, we have traders. Now, go from bottom up. So when you buy stock, right, you use a broker. A broker is a platform that facilitates exchange between you and another trader, right? But then brokers themselves hire and pay clearing firms to act as intermediaries to connect them to the DTC. So once they're connected to DTC, it means they can provide more liquidity in the meantime while the funds settle. So this is a rough outline of how trading works in the US. Now, why does this matter? Keep listening.
Now, because GameStop, AMC, and KOSS are so volatile, DTC has raised that requirement collateral rate to 100%, meaning that for every single dollar that exchanges hands in those stocks, the clearing firm has to send for deposit for 2 whole business days that exact same amount of the notional of the trade. Now, when we're talking about GameStop at $250, $350, billions of shares trading, we're talking about hundreds of billions of dollars that the clearing firm physically has to send in cash to DTCC to hold there for 2 whole business days. And to be frank, the clearing firms are not that well capitalized. They can't do that. So in order to stop the clearing firm from going out of business, they stop the settlement of those shares, resulting in firms like Webull not being able to allow customers to trade those stocks, right? It's a market dynamic.
So, what did Anthony say there? Pretty much, DTC, without warning, raised collateral from 3% to 100% on a variety of stocks, such as GameStop, AMC, and KOSS. Now, what is the impact? Right? So now clearing firms, instead of only having to give away 3% for collateral, now have to hand over 100% cash collateral to DTC for every single trade on these 3 stocks. And remember, these 3 stocks, between them, there's hundreds of billions of dollars traded constantly. How can a clearing firm possibly hand out 100%? Remember, 100% is much bigger than 1 to 3%. It's not that they raised it to 5%, 10%. They raised it all the way to 100%. So what's the answer? Clearing firms obviously cannot provide the required collateral that DTC wants to provide liquidity. So what is the result? The result is that the clearing firms called up the brokerages and told them to shut down trading. Because if they don't, they will go out of business because they will not have enough collateral to give over for 100% cash. Right? So for example, Robinhood and a variety of other exchanges, briefly on Webull, but Fidelity, with their own clearing firms, they had enough cash on hand, so they did not halt trading, but a large amount of brokerages did. Right? So for example, Robinhood shut down all selling of GameStop and other volatile securities. Now you ask, did DTC know this was going to happen? Hell yeah, of course. That's why they did it. They did it on purpose. Why? But why did DTC suddenly raise required collateral to 100%? Why did they do this on purpose? Keep listening.
And what's going to happen if DTC doesn't move that, right? So we want to blame DTC. We want to say DTC is the bad guy. They're raising requirements to 100%. Well, what happens if they don't do that? Then you have counterparty risk. So if I sold a share of GameStop to someone at $350 and that person was short and covered a short, say that person was Melvin Capital. Melvin Capital is now completely underwater. They don't have enough money to pay for that purchase to cover their short position. So now the clearing firm is going to pay on behalf of Melvin Capital. And then the clearing firm will try to collect that money from Melvin Capital down the line later on. If they don't get it, they mark it as a loss. Now multiply that billions of times. Now the clearing firm can't pay to settle those trades. So you have billions of people that sell stock that aren't able to get capital back for that sale You have counterparty risk. That means that you have a complete market breakdown, and it's a bigger story than just GameStop. It's the whole market is not able to function.
Yeah, you heard him right. And then he just said the entire U.S. securities exchange market was about to collapse. Just random Thursday and a random week, the entire U.S. securities exchange market was about to collapse. What? How? To understand this, you have to understand Melvin Capital and a bunch of other hedge funds are short over 100% float for GameStop, right? So that means if GameStop prices kept going up with the short squeeze and gamma squeeze, Melvin Capital will be unable to pay and cover their shorts. Then it would trickle down to the clearing firms who will be on the hook. Remember, clearing firms are the ones who connect them to the DTC. But we are talking about billions of dollars here. Clearing firms will be in water as well because they simply don't have enough capital on hand. Meaning, if you sell a share, you won't receive a penny because no one can pay. So, what's the result? Counterparty risk and complete market breakdown. It gets worse. Clearing firms being underwater would cause a domino effect to the entire market. Remember, clearing firms help clear pretty much every security traded on the exchange, right? So if clearing firms go under due to GameStop, then not a single security on the marketplace could be cleared, right? So AMD, Apple, Amazon, whatever stock, they could not be cleared because the clearing firms are going under due to GameStop, due to Melvin Capital not able to cover their shorts, right? So the entire market would have collapsed. That's why DTC suddenly required 100% collateral, so price of GameStop wouldn't keep squeezing up, so Melvin Capital wouldn't go under, right? So they needed Melvin Capital to not go under, so clearing firms don't go under, so the entire market doesn't collapse. Now, let's look at a similar case study that happened in 2008. I don't remember what happened in 2008, but I seem to remember a certain financial crisis. Just a small financial crisis. But Lehman Brothers, remember Lehman Brothers? They collapsed. They were an investment bank, but they were also a clearing firm as well, right? And Lehman was the clearing firm for many other hedge funds. So when Lehman collapsed, the hedge funds that it supported also became counterparty risk. The result? Complete market breakdown, which is why the U.S. government had to come and bail them out. But who bailed out Melvin Capital and the other short hedge funds this time? That's right, the retail traders. When DTC suddenly required 100% collateral, they knew these platforms like Robinhood and Webull would have to stop trading, right? And when they stop trading, prices go down, and that's when Melvin Capital can save themselves as the price crashed from 480 to about 112 within less than an hour after DTC raised required collateral to 100%. So who's responsible and who to blame? So fuck the DTC, right? Should we just all go and game bang DTC right now? Not really. You have to understand, although DTC did this on purpose by raising required collateral to 100% cash, they only had two choices, right? One, leave everything as it is, not intervene, and let the market collapse. The entire U.S. securities exchange market collapse. Or two, screw the few GME holders to protect the rest of the market. You can't really blame them, right? Then who do we blame? Do we blame Robinhood? Lots of hate for Robinhood, but I feel bad for Robinhood because they're just a platform where traders can exchange securities, right? It's not their fault that its clearing firm couldn't handle the 100% collateral requirement by DTC. Like, it's not they did not make the conscious decision. Then who do we blame? Who made the conscious decision that led to everything? It's Melvin Capital and the other hedge fund shorts. Their greed almost collapsed the entire U.S. securities exchange market and potentially globally as well, likely, because they over-levered and shorted 140% of GameStop float, shares available to trade. They made a horrible call trying to profit off of a struggling business with insane leverage. They did not manage their risk at all. You guys know, the number one rule on my channel, how I trade profitably, consistently, is to control my risk, manage my risk. They did not manage the risk. They over-levered. They fucked up. But who does Wall Street blame? Who do these people blame? These people blame retail traders and Wall Street bets. Their reasoning is, if everyday folks didn't discover our evil and irresponsible strategies, this never would have happened. Fuck you. Alright, I'm gonna leave you guys off with this this meme. It's from my favorite show, cartoon show, Family Guy, adult cartoon, animation. Don't worry, fish. I'm gonna take care of you. Because I know one day you'll do the same for me. You know, when kids were little and shit. And then, the next one is, I don't care what it costs. Just make this man well again. So, you know, the Zoomers, millennials are now, you know, helping out GameStop. And in solidarity with my Wall Street bets and GameStop brothers, I'm going to go on my YOLO account on Robinhood. You guys know that I day trade in Webull. But I do have a Robinhood YOLO account. And although fuck Robinhood, they're not really the ones at fault here, right? They were just the middleman. They were being hurt, so they had to hurt us. Made sense. But I'm going to get 5 shares of GameStop that I'm going to hold overnight. Well, for the foreseeable future, for the next month or so. You guys know that I'm a day trader, right? I never hold overnight. I make intraday scalping trades on breakouts. But I'm going to make an exception for GameStop because fuck the hedge funds. It is simply not fair for hedge funds to be too big to fail. When they make a bad decision, the entire market collapses, so they can't fail. The DTCC bent the rules to prevent a market collapse, which was caused by Melvin Capital. These big hedge funds should not be allowed to take these huge risks. Fuck them. Something needs to be done about this. There needs to be repercussions. So I'm going to be joining the Diamond Hand again and get 5 shares. Let's see. All right, there we go. But keep in mind, guys, only buy into GameStop whatever you can afford to lose. Robinhood is my YOLO account. I can lose everything in this account. I don't care. But don't use money you need, guys. Like, only use money you can, like, you don't care about losing, right? But join the good fight. Fuck the hedge funds. Let's go.